So hello and welcome to this webinar on taking benefits from pensions. On the agenda then for today, I'm going to start by looking at when benefits can be taken, and then I will turn and look at the different options that are available in terms of the form of benefits. First of all, looking at the lump sum options, then I'll go through the income options, and then I'll finish off with a little bit on how pension benefits are taxed, and in particular the taxation of flexible pension payments, because there can be a few issues around that, so it's a good one to have a good understanding of. Okay, so I'll start off looking at when benefits can be taken. So for most people, they're going to be able to access their pension when they reach normal minimum pension age, or NMPA. So this is set at age 55 at the moment, but we know it is written in legislation that is going up. So it is 55 now, and it will go up to age 57 from 6th of April 2028. That's going up. It is, if somebody has started taking benefits already, but they reach 55 before then that's fine, they should be able to continue. What's not clear yet is if somebody is like done a partial crystallization, taken some benefits, whether they'd be able to add to that if they were like in the window in between. They may find that they have to wait. They can carry on taking anything they've accessed from age 55 if it's before that date, but then after then they would have to wait until they're 57 to have more funds added to that. The next condition that can be met is if somebody has ill health. So this is hopefully not one we come across too often, but you may have a client that have fall into poor health and therefore want to access their pensions before normal minimum pension age. So these requirements are that they have to be incapable of performing their current occupation and continue to be incapable of performing it, so an ongoing condition, and actually have ceased to perform whatever their current occupation is. So those are the rules that are in the legislation. It may be with certain pension schemes they are stricter than that, schemes can do that. For example, in an occupational scheme, it might say not just that you have to be incapable of performing your current occupation, it could be they could put a requirement in there that you have to be incapable of performing any occupation. So an obvious example would be if somebody had a physical job and if they got injured and they couldn't work, they couldn't carry out that job, but they could do a desk job instead, for example. Now in that scenario, it would depend on the scheme rules whether that would qualify for the ill health condition or not. In terms of our schemes, it is just you have to be incapable of performing your current occupation. So if somebody, whatever their job is, they have to stop it because of the health condition. We have confirmation in writing from a suitably qualified medical practitioner to state that they cannot continue in their occupation and they're not likely to recover and be able to come back to it, and a confirmation from the member they have actually ceased their current occupation, then that would be sufficient to meet the ill health condition, which means you could actually access your pension before the age of 55. And then finally on here, we have protected pension ages. So we actually have a couple of different protected pension ages now. But the first lot we had was back in 2006. So when A-Day changes came in, before 2006, we used to have a list of prescribed occupations where people could have an earlier retirement age, and provided they were in an occupational scheme linked to that occupation, and 2006 they can keep that protected retirement age. So these were normally sports people. The obvious example there is that's our England 2006 squad. Apologies for those of you in Scotland watching. But the squad there, they would have, if they've been in the players scheme at the time, they would all have been qualified for the early protected pension age, which for footballers was 35. But there was a whole list of other sports, it was generally sports people on it, dancers and things like that as well, have protected pension age. Now, they could still have it if they stay in the same scheme. They would still have that earlier protected pension age. They could transfer it as well, but it had to be a block transfer. So it's just two or more members of the same seeding scheme going to the same receiving scheme at the same time. Then they could keep that protected pension age on transfer. So we certainly do have people in our scheme with protected pension age, even though it wasn't acquired in our scheme, but they've transferred in as a block transfer and kept that protected pension age, and that can continue. We also had another change in normal minimum pension age back in 2010. So it used to be age 50 before it went up to age 55. And if people were in certain occupational schemes on that date and had the right on that back in 2010 in certain schemes, then they could keep that 2010. And again, it could be block transfers. They could potentially keep that as well. And going forward, when the rules change, the NNPA goes up again from age 55 to 57. We have another load of protection for, again, certain schemes. If the scheme had an unqualified right to take pension benefits at age 55, that could be kept on transfer. It's a slightly different kind of block transfer for the newer ones, which I'm not going to go into all those details today, but just to be aware of, we do have these protected pension ages, but for most people it's age 55, but it is going up to age 57. So once you've reached the magic age, how can benefits be taken? So first of all, I'm going to look at lump sums. So we have a number of different lump sums that can be taken from pension. So I'll look at these all in a little bit more detail. First one, by far the most common one, is a pension commencement lump sum, PCLS, also known as tax-free cash. We then have scheme-specific lump sums, which are a type of PCLS really, but you just slightly different rules around that, which I'll look at. Uncrystallised funds pension lump sum, which is a bit of a mouthful. UFPLS, UFPLUS, I've heard it called. All the same thing on that one. Small pension payments. Serious ill health lump sums, which there are certain conditions for that, which is different to the ill health taking benefits early. This is a different set of requirements for serious ill health. We then have trivial commutation lump sums, TCLS, and winding up lump sums. Now those last two are only available from defined benefit pension schemes, from DB schemes. The rest of them are payable from DC schemes. But when it comes to taking lump sums, we have a couple of allowances that I'm just going to go through first. So as we know, the lifetime allowance has been abolished, so that has gone, so we don't have to look at that anymore. We don't have any tests on the overall benefits you can take from a pension, but we do have tests on the amount of lump sums that you can take. So we have, first of all, the lump sum allowance, which for most people will be £268,275. Maybe some people who have protection which have a higher level. Yeah. And then we have the lump sum and death benefit allowance, or LSDBA, which is set at £1,073,100. And again, it may be that some people have a higher level because they had protection under the old lifetime allowance. So looking at the lump sum allowance first, whenever somebody takes a PCLS payment, it is tested against the lump sum allowance. And also, if they have taken a UFPLS payment, then it's just the tax-free element of that that's tested against the lump sum allowance. When it comes to trivial commutation and winding up lump sums, it's a little bit different because you have to have some lump sum allowance available, but it doesn't actually use it up. So it's a bit of a funny one. So you could have £1 of allowance left, and that would then allow you to take £5,000 trivial commutation lump sum or a winding up lump sum, for example. So it doesn't actually use it up, bit of a funny one. Once you've used up your lump sum allowance, then basically you can't have any more tax-free cash out of it. Anything else you take, any kind of lump sum, would be subject to income tax. LSDBA then, so the lump sums which are tested against the LSA are tested again. So what by that I mean that PCLS and the tax-free part of your UFPLS, at the same time as they're tested against the lump sum allowance, they are also tested against the lump sum and death benefit allowance. Now obviously the lump sum and death benefit allowance is a lot higher for the lump sum allowance, so it's not going to be the restricting factor, but the point is it does use some of that allowance up. Serious ill health lump sums are just tested against the lump sum and death benefit allowance and any lump sum death benefits that are paid out. Now, this is only applies to lump sum death benefits where the death is under 75 and the benefits, and it's only applies to benefits that have been crystallised since the 6th of April 2024. So benefits that have been tested under the tested against the old lifetime allowance aren't tested again against the lump sum and death benefit allowance. In most circumstances, certainly from SIPs, you will normally have the option of being able to pay death benefits as income, in which case then you're not going to have a test against the LSDBA if that is the case. And again, worst case scenario, if you are paying out lump sum death benefits, then any excess is subject to income tax, which is why I say there's only a test on it if it's before age 75, because it's after age 75 it's all subject to income tax anyway, so it doesn't make any difference on that. So looking at PCLS then, and what the rules are now. So PCLS tax-free cash, we generally think of it as basically is you can take a maximum of 25% of the amount of the fund that you're crystallising. That's certainly how it used to refer to under the old lifetime allowance. Just because taking income doesn't crystallise in the same way, it's not a benefit crystallisation event under the new rules. The way it's drafted in legislation is a little bit different now, but in practice it is the same thing. So instead of saying it's 25% of the amount you crystallise, what we say is it's the permitted maximum. It's the lowest of the applicable amount up to your available LSA or LSDBA, and the applicable amount is a third of the amount that you use to provide an income. So if you're going into drawdown, it's a third of the amount you put into drawdown, or the third of the amount you use to buy an annuity, or the third of the amount of the capital value of the scheme pension that you are starting to take on that. So it works out as the same thing. So if you've got a £100,000 pot, you use £75,000, you put £75,000 into drawdown or buy an annuity, then you can take £25,000 as tax-free cash as PCLS with that, provided you've got enough lump sum allowance available on that. Probably worth mentioning, there is another kind of lump sum which I haven't put on the slides, which is a pension commencement excess lump sum, PCELS. That only applies for DB schemes, really, in practice, because basically what that does is it allows you to have PCLS. So of your, it's still the applicable amount. It's still, you know, a third of the amount you're used to. If it's a DB scheme, it's going to be scheme pension. But if you've used up all your available lump sum allowance, it's a method really that the scheme can still pay it out as a lump sum, but it will be subject to income tax, a PCELS. Particularly as excess lump sum. In practice, you're not like to see it from a DC scheme or from a SIP, because you just put it to drawdown and take it as drawdown because it's easier. So there isn't a need to do it in that way, but there is a lump sum technically that exists. I think it'd only really be DB schemes that would use it, which is this pension commencement excess lump sum. Next one I've got is a scheme specific lump sum, or SSLS. This is the old protected tax-free cash. So this is going back to people that had more than 25% of their fund that they could take as tax-free cash back on A Day in 2006. So when they had this protection, it was scheme specific, so specific to that scheme. You didn't have to register for the protection, but the scheme administrator would have a note of the amount that they were entitled to at A Day. And a bit like the protected pension ages, it could be kept on transfer if it was a block transfer. So there may be other schemes that have it now, but you have this right, and it's a monetary amount that you could take at A Day. So the way it's calculated now when you come to take the scheme specific lump sum, it's whatever that monetary value was back at A Day plus 20% uplift, and then you get 25% of the increase in pension rights since that date. So the calculation under the new rules is pretty much the same as it was under the lifetime allowance. There's no big difference in terms of how that's calculated. But before, we used to have to, work around the lifetime allowance and what was available to the lifetime allowance. Now, with the new allowances, basically, if you take a scheme-specific lump sum, the lump sum allowance is used up as if you'd taken 25% PCLS, even though a higher amount has been taken. But importantly, you only need to have lump sum death benefit allowance in order to be able to take a scheme-specific lump sum. You don't need lump sum allowance. And this can make quite a big difference when it comes to the order of taking benefits, particularly if you have clients that have a scheme-specific lump sum, but also have another pension scheme somewhere else which just has the standard 25% PCLS on it, and they've got a high value of pensions in total. So I've got a case study to sort of highlight that. So this example I've got here is if you've got a client who's got £1.2 million in their SIP, which has just got your straightforward 25% PCLS on it. Obviously, it'd be restricted by the lump sum allowance, but also they had a Section 32 from ADA, £500,000 in that, and that's got the scheme specific lump sum on it, which works out as £175,000. So if they access the Section 32 first, then the scheme specific lump sum of 175,000 would actually use up 125,000 of their lump sum allowance. When you take a protected lump sum, you have to take all your funds in one go. You can't do partial crystallisations. If the whole fund is taken out, so it's 500,000 and it's 25% of that, that's the amount of lump sum allowance that's used up, regardless of the fact you've actually had a payment of £175,000. Now, if this client had just the standard lump sum allowance of £268,275, that leaves them with £143,275 left of their lump sum allowance, which they can use to take the PCLS from the SIP. So the total tax-free cash they've taken across both schemes would be £318,275. So that's how much of the LSDBA has been used. They've used up all their lump sum allowance. But if they did it the other way round and took the SIP first, they could use all of their lump sum allowance to take PCLS from the SIP, so the full 268,275, no LSA left. But because you only need LSDBA and not LSA to take your scheme specific lump sum, they could still take the 175,000 on top of it. So the total tax-free cash in that scenario is £443,275. So it can make quite a significant difference there, the order in which you take benefits. So it's you might not have clients in that situation, but just in case you had the odd one, it can be really important. So lump sum allowance is used up, all gone in both scenarios. The second scenario there does use up more of the lump sum death benefit allowance, because the lump sum death benefit allowance is used up by what you've actually taken. But when it comes to most people, they're never really going to face a test against the LSDBA, because if death benefits can be paid out as income to beneficiaries, then it's not tested, or if you live past 75, it's not tested anyway. So it's not usually a factor for people to consider. Okay. Next up is UFPLS payments. So UFPLS payments are usually paid 25% tax-free, 75% subject to income tax, but that is provided they have enough lump sum allowance available. So because the tax-free element uses up your lump sum allowance. Once it's gone, you can still have UFPLS payments now. It used to be the case under the lifetime allowance, you could only have UFPLS payments up to the available lifetime allowance, and you just couldn't have them after that. With the new allowances, it's a little bit different. So you can have a UFPLS payment even if you've got no lump sum allowance. However, it's all going to be taxed as income. So it's not always 25% tax rate. It normally is, but for the X1 excess, you can have it. You can take it in that way. Again, normally, with a SIP, you just put it into drawdown and take it like that. It's probably simpler, but it is possible to do it. Taking any UFPLS payment will trigger the money purchase allowance, the MPAA, so it restricts how much you can put into money purchase pension schemes going forward. Taking PCLS, I should say, obviously doesn't do that. Taking UFPLS payment does do. Oops, clicked too far there. Small pension payments. So these are pension payments up to £10,000. So the requirement here is that you take the whole lot in one go. You have to extinguish all entitlement under the arrangement. these were put in place as a tidying up exercise. You know, if people have very small pension funds, it's, you know, not worth keeping them going effectively. The rules were put in, you know, before we had flexi excess drawdown, before we had pension freedoms, and it was a way, yes, so you didn't have to keep administering very small pots, that people could just take them out. So there's a maximum of 3 payments in members' lifetime. So if they have 3 different, if you have 4 different pots with £9,000 each, you can't do it 4 times, you can only do it 3. If you're talking about personal pensions, you can take it unlimited from DB schemes. With personal pensions, you can only take 3 in their lifetime. They are taxed as normal, so there isn't from an income tax point of view, there isn't an advantage of doing a small pension payment, because if it's uncrystallised rights, you only get 25% of it tax free. The rest of it is taxed as income, you know, and if you're doing it from rights that are crystallised, then it's all taxed. So if you know, it's taxed the same as if you took PCLS and drawdown, or if you took a UFPLS payment. The only advantage on it, the main advantage, is it's not tested against the lump sum allowance or lump sum death benefit allowance. That is the big difference on it. So, you know, some people may do it, you know, for that reason. If lump sum allowance has been used up, that you still got a little bit of pension somewhere else, then you can do this, and it doesn't trigger the money purchase annual allowance. Moving on to serious ill health, so hopefully one you don't see too often. We don't do many of them. I think there's only 1 or 2 a year. So, you know, it's a fairly rare, thankfully, that we have to do serious ill health payments. So basically 3 requirements to take a serious ill health lump sum. First is they have life expectancy of less than a year. Obviously, we need this to be, you know, from a confirmed by a medical practitioner. Only from uncrystallised rights. And then when you make the payment, it has to be everything from that arrangement. That's an uncrystallised arrangement. You have to pay all of it out. You can't do a partial drawdown of this, a partial serious ill health lump sum. You have to take everything from that arrangement in one go. And the advantage on that one is that it is completely tax-free. It is a tax-free lump sum up to lump sum and death benefit allowance, so it does allow large payments from uncrystallised funds, provided the member is under 75. If they're over 75, then it's taxed anyway, so you may as well just do it under drawdown rules. There's not a benefit to doing it as a serious ill health lump sum. So again, that's why we don't get very many of them, because, you know, you have to be under 75 for it to be worth doing, and it's got to be uncrystallised funds, you know, and obviously taking all the money out in one go on that. Final lump sum I'm going to go through is the trivial accommodation lump sum. So I've mentioned this is only for DB schemes, and there's a limit of £30,000 across all schemes, and you have 1 shot at this. So there's 1 12-month period. You know, if somebody's a member of a few different schemes, you have to do it all within a 12-month window to do this. Otherwise you can't. Taxation, again, there's no income tax benefit from it. You know, if it's from crystallised rights, it's still subject to income tax, or 25% tax, 75% taxed if it's uncrystallised rights. And it's not tested against the lump sum allowance, but say this is the one that said, you know, you could just have £1 of it available, and you could take £20,000 as a trivial accommodation lump sum. But it's really one for, say, DB schemes is a tidying up exercise, you know, so they don't have to administer small pots and pay scheme pension at a very low level out of small pots. They could do a trivial accommodation lump sum on this. Say you can't do it from DC schemes, but there's no need, because you could just pay it out as drawdown, PCLS as drawdown, so there's not really a need for it on that. Turning now to income then. So if we look at the various income options, so by far the most popular thing that people do when they access their pension is to take a pension commencement lump sum, and then when they take a PCLS payment, they then use the rest of the fund to provide an income. So under a DB scheme, you can take PCLS and then have scheme pension. You don't have to take a PCLS payment. You could just choose not to and take a higher level of scheme pension. That is possible. You can have a lifetime annuity. So if you have a DC scheme, so you have such as a SIP, you could have PCLS payments and then purchase a lifetime annuity with the rest of your scheme. It may also be that there's some certain DB schemes will actually secure the scheme pension by means of an annuity, so that the trustees will actually buy an annuity to meet their obligations and to pay out the scheme pension by means of an annuity as well. In SIP world, obviously the most common thing that we have is people take PCLS and put funds into drawdown, and we have two forms of drawdown. We have flexi access drawdown and we have capped drawdown. So scheme pension, lifetime annuity are what's called secure income. Flexi access drawdown is unsecured income. When it comes to triggering the money purchase and annual allowance, taking income from flexi access drawdown triggers money purchase annual allowance and restricts the amount you can put into pensions, into money purchase defined contribution pensions going forward. Taking income from cap drawdown doesn't, nor does taking income from an annuity or a scheme pension. Just a quick note on flexible annuities or fixed term annuities. These are written under drawdown rules, so they are classed as flexible pension payments, do trigger the MPAA. They're normally say drawdown rules. It's just a lifetime annuity which is different on those. Now, under the new rules, so post lifetime allowance, there are no tests for taking income. So when somebody accesses benefits, it's only the tests that apply to the lump sum, which I've just talked about. There are no tests for any of these payments, any income payments at all under the new rules. Looking at drawdown then, so say by far the most popular thing to do with a SIP. So we have flexi access drawdown and we have capped drawdown. Both kinds of drawdown funds remain invested. So when you take a pension commencement lump sum, as I said, you know, you're restricted by permitted maximum of 1/3 of the amount you put into drawdown or buy an annuity with a scheme pension. So if you're going for the drawdown option, you have to put funds into drawdown in order to be able to take your PCLS. It doesn't mean that you have to take the income straight away. Your funds remain invested, but it means they are designated to drawdown, and the clients can take an income from them at any point in time, and they can take regular payments, you know, that could be monthly, quarterly, annually, or they can take ad hoc payments. You know, flexi access drawdown particularly is very flexible. You can take whatever you want. Any payments that are taken though, whether it's flexi access drawdown or capped, will be taxed as income under PAYE. Flexi access drawdown, if you've got clients who are starting to take income for the first time now, taking drawdown, this is the only option they have available in terms of drawdown. That's been the case since 6th of April 2015. Cap drawdown was the old version of drawdown, but you have to be in cap drawdown before 5th of April 2015. If that's the case, it can continue and you can add funds to it. But if you haven't got a cap drawdown arrangement already, you can't start one. So flexi access drawdown, as the name suggests, very flexible, no minimum, maximum, don't have to take anything. You can take the whole lot out in one payment if you want. Cap drawdown, we have a cap on it, so it is reviewed every 3 years. So whatever the date the first went into cap drawdown, on the anniversary date, every 3 years, that maximum level of income gets reviewed, and until you turn 75, and after the 75th birthday, it's reviewed every year. The idea of that is that, you know, it's designed not to run out by having this cap. It was to protect people. Obviously, pension freedoms came along and threw all that out the window and said you can take what you like. So taking an income payment under flexi access drawdown triggers the MPAA. Cap drawdown doesn't trigger it. Cap drawdown reviews then, so these are based on age at the date of the client at the date of the review, the yield on the UK gilts on the date of the review, and how much they've got in their pension fund. And we have these GAD tables. The picture here is just an extract from the current GAD tables, which you've seen we've been around since 2011. We are getting some new ones this year, 1st of September 25, slightly lower rates on them, which will be coming, say, in September. I've highlighted the column there with 4%. 4%, that's the applicable gilt yield for May 2025. So you look at the age on the left hand side, you look at the appropriate gilt yield depending what it is, each month, and you'll see there's a figure in there, and that's per £1,000 of pension pot. That is what's called the basis amount of income you can take. But you can take 150% of that now. Since pension freedoms, it went up a bit, so you can have 150% of that basis amount. That's how the maximum annual payment is calculated for drawdown. So it's reviewed every 3 years up to 75, annually after 75, but there are certain trigger points for ad hoc reviews. One is if you designate more funds into that drawdown pot, you add some funds to it. Member can just request it. If they want to take a high level of income and they've had some big investment growth, for example, they might have had a property in there and they've sold it, and they've sold it at a good price or whatever, they could request an ad hoc review, which would give them a higher level of cap drawdown. Going the other way, pension sharing orders, that is on divorce. If somebody gets divorced and they have a pension sharing order applied to their pension, so there is a debit, so they're having to pay some of their pension across to their ex as part of the divorce. With a pension sharing order, it means that they have to have a review done at the time of the pension sharing order, but it doesn't apply to the end of the pension year. So whatever the anniversary date is for them starting their drawdown, the test is done at the time, but it only applies from the start of the following pension year. So that just means that they can't have taken too much, and then when the review is done, obviously it's going to reduce the amount they can take if they've had a pension debit against it. And similar for a partial annuity purchase, because going into drawdown, whether it's flexi access drawdown or cap drawdown, it's never a final decision. Clients can do this. They can buy a lifetime annuity out of their drawdown fund at any point, when they decide they want to opt for secured income instead. And they don't have to use the whole fund. When you're talking about buying a lifetime annuity, they can just use some of their fund to secure an income with a lifetime annuity and leave the rest in drawdown. But that would trigger review if you're in cap drawdown. And again, it would just apply from the start of the next pension year on that. Just a little one to know, if fixed term annuities, flexible annuities, you can't do partial purchases of those because effectively, because they're written under drawdown rules, they're a transfer out, and so you can't do a partial transfer for that, but you can do a partial annuity purchase if it's a lifetime annuity. And also, once you're in cap drawdown, you can convert to flexi access at any time. You can just tell your administrator you want to change, and then you don't have to have the reviews done anymore, and you're not got any cap on the level of income you can take out. But obviously, once you start taking income under flexi access drawdown rather than capped, then you do trigger the money purchase on your allowance. Turning to partial drawdown then. So I said whenever funds are designated to drawdown, then associated PCLS can be taken. Entering partial drawdown initially creates a new arrangement, which is a drawdown or a crystallised fund. So you would have, your pot's uncrystallised, and then you want to crystallise some of it. You want to do partial drawdown. That creates a separate arrangement within the SIP or pension, whatever kind of pension is. Then investments can be ring fenced or notionally split between arrangements. So what I mean by this, on the left here, this is what I think ring fencing looks like. So you have a drawdown fund and you've got certain investments which you've kept in the drawdown fund, and then ring fenced separately you've got an uncrystallised fund which may have different investments in it. You could have the same investments in both, that'd be your choice, but the point is they are ring fenced and they're kept separately. Or probably more common amongst SIP providers, and this is what we do, is we have a notional split between arrangements. So ours looks more like this one over on the right hand side. So you have here, we've got 4 different funds in here, we've got a couple of different shares and holdings in here. That's across the whole pension scheme, but we just have a notional split at the bottom. So we have a certain percentage which is your drawdown pot, and then a certain percentage which is your uncrystallised fund. And obviously, if you take money out of your drawdown fund, that's going to reduce that percentage. If you put contributions into your uncrystallised fund, it'll increase that one. And so it can change over time on that. Another way of looking at this is if you have like Barry here, he's got his SIP, he's 60, he's got £600,000 in his SIP when he comes to take benefits for the first time. If you decide to crystallise £100,000, it would look something a little bit like this on the left hand side, whereas you have 25% of the amount you've crystallised there is PCLS, so that's 25,000 PCLS payment that can go out to Barry, and then he's got 75,000 that he's designated to draw down, and he still has £500,000 fund that's uncrystallised that he can take benefits from in the future. After he's taken out his 25% PCLS, his fund value is now £575,000, of which 75,000 of that is crystallised, which is the dark bit on the left, and 500,000 is uncrystallised. And then if you do the percentage on that, we would say 13.04 is crystallised funds and 86.96 is uncrystallised funds on that. So he can take more PCLS from the uncrystallised part in the future, but not from the crystallised. Crystallised funds he can take income from whenever he wants, but he doesn't have to. He can just leave it there if he just wanted the PCLS. He can still leave that in there to grow. You can take further PCLS in the future and designate more to draw down. So he might take another chunk there and take the PCLS out, 25% of the bit he's designating to draw down at that point. The point is crystallising at that point, I should say. So he gets more crystallised funds. His uncrystallised pot is shrinking, and you can carry on doing that, taking more PCLS out, crystallising the rest of the funds until you have just crystallised funds left on that. There are a few complications when it comes to sort of drawdown and different arrangements and things, just to make things a little bit more complicated. So pre-A-Day funds, I'm talking about funds that went into drawdown before 6th of April 2006. They have to be kept separate. That's written in legislation, so we have to always keep those separate, and you can't add any more funds to them. So if you have other uncrystallised funds, you can't designate them and add to those pots. You have to keep pre-A-Day funds separate. If you transfer funds that are in drawdown, once funds have gone into a drawdown arrangement, you can't split those on transfer. They have to be kept. That drawdown pot has to be kept intact. So once it's transferred, it has to be kept separate from other funds, but then it can be added to. So for example, if you have a drawdown fund with provider A and you're transferring to provider B, and you already have a drawdown pot with provider B, there's two drawdown pots, transfer one into the other, you can't merge those pots together. They have to be kept separate. But even after it's transferred, if you also have an uncrystallised pot, you can add to it, but you can't merge them on transfer. I think that's kind of back to the cap drawdown days when that rule was invented, and different anniversary dates and reviews and things. In the world of flexi access drawdown, it doesn't really make a lot of sense. I think it's a bit of a legacy issue, but it's still in the legislation, so administrators still have to do it. It does mean you can end up with lots of different pots within one pension. So you might end up with a pre-A-Day fund. You could have a cap drawdown fund. You can have uncrystallised funds. You can have flexi access drawdown funds. And in fact, it could actually be more complicated than that, because you could have multiples of any of those. If you had two different transfers in from pre-A-Day funds and a few other different drawdown transfers in, you could end up with lots of different arrangements in one pension scheme, which is kind of ring fenced like that, or with a notional system. I say like most SIP providers have, it could look a bit more like this. So you might have one of them with a percentage which is a pre-A-Day fund, a percentage that's a cap drawdown fund, a percentage that's flexi access drawdown fund, and another percentage that's uncrystallised fund. But you have your investments across all of them, and it's just a percentage split which the scheme administrator will keep track of on that. Transfers. Yeah, I've already mentioned this. Transfers, drawdown transfers have to be on a like-for-like basis. So you have to, you can't transfer a scheme pension to drawdown or uncrystallised funds to drawdown. It has to be drawdown to drawdown. For things like cap drawdown to flexi access drawdown, you actually have to do the cap drawdown to cap drawdown transfer, and then you can, the second it hits, if you like, you can change it to flexi access or we can change it before it transfers, but technically there has to be like for like when you do the transfer, but it can happen pretty instantly afterwards on those. But yeah, the main point is, you know, it's a drawdown transfer. It's going to be drawdown when it arrives. Crystallised funds, you know, you can't split it, so you can't do this partial transfer of drawdown funds. It has to be all or nothing on it. And it has to go into a new arrangement in the receiving scheme. So if the receiving scheme already has a drawdown arrangement, you can't just put your transfer into it. It has to be kept separate on it, on that. One last thing I'm going to mention on this is around the statutory permissive override. So this goes back to pension freedoms in 2015. So when the rules came in, it was quite rushed. So having this facility to have flexi access drawdown, what was actually happened, the legislation put in place, so the statutory permissive override, which basically means that doesn't matter what's written in pension scheme rules, any money purchase defined contribution pension scheme can offer flexi access drawdown. It was done so schemes didn't have to rewrite their rules in time for 6th of April 2015 in order to be able to facilitate these payments. So any DB, sorry, not DB schemes, any DC money purchase scheme is allowed to offer flexi access drawdown. So if any scheme can designate funds to flexi access drawdown, then they can do a drawdown to drawdown transfer. And this can be useful particularly for schemes that say they don't actually pay drawdown, and in particular it can be relevant for schemes, for example, like Section 32 policy, which may have protected tax-free cash in it, protected the scheme specific lump sums I was talking about earlier, because with those schemes, particularly if you have a single member scheme, you can't transfer in a block transfer. You know, you can't transfer it without losing your protected tax-free cash. You don't want to transfer it, but it may be the scheme only has the option of buying an annuity, but actually you don't want to buy an annuity. You want to have your protected tax-free cash, but you'd like to have drawdown. So this statutory override means that because that is a defined contribution pension scheme, the scheme can designate funds to drawdown. It doesn't matter that it's not in their scheme rules. And also, it doesn't actually matter that they can't physically pay it out. They don't have the systems to pay it out. They can't do it because all they need to do is pay out the tax-free cash and say designate funds to drawdown. Basically, all they need to do is confirm to the receiving scheme that they're going to transfer the drawdown funds to, is that they've designated it into the member's name, the date they did it, the amount of it, and then technically they have to confirm whether the MPAA has been triggered, but as they won't have actually paid out an income, it won't be triggered. So really all they need to do is, you know, put it in writing, the facts of what the fund value is, yes, say it's been put into drawdown, and then pay it across to a provider that can facilitate the drawdown payments. After pension freedoms came out, there were a few providers who were kind of a bit computer says no on this. Some of the older providers with, you know, particularly single member schemes and things that only offered annuities, that they, you know, they wouldn't allow it because they said the scheme rules didn't allow it. And I think we did have quite a few debates, shall I say, with some of their technical departments to try and get some of these through, which was successful pretty much. And I think it's probably a lot less of an issue now because I think most schemes know about this, and they will, you know, offer it. But in case you come across any that don't, you know, it's worth knowing about that if that's what you want to do, then there should be a way of doing it. Okay, last section now. We're going to talk a little bit about the taxation of pension income. So, mentioned already, any income payments are going to be subject to income tax, and that is under PAYE. But when payments first start, there can be issues with overtaxation, and these issues are quite significant. This chart shows the amount of total tax HMRC has had to repay since pension freedoms because they have taxed people too much money. It's not the tax they've taken, it's how much they've overtaxed and had to repay back. So the figures, they didn't quite start with pension freedoms in April 2015. There was a slight delay in the figures, but going back to Q4 2015, these are their report on it quarterly, the overtaxation payments they've had to repay. And you can see we've got some quite significant figures here. Q3 2003 peaked at over £60 million of overpaid tax. HMRC had to repay to people in 1 quarter alone. And up until the end of last year, end of 2024, it was over £1.3 billion that HMRC had taken off people because of the way the tax works, and that they'd had to then repay through the reclaim system. People that waited to the end of the tax year and then just sorted it all out via PAYE at the end of the year aren't included in this figure. So there will be much more than this as overtax. These are the people who have actually taken the time to claim back rather than wait for it at the end of the tax year. So it's a really significant issue, and one that we've been campaigning on, and not just us, because it's a known issue. There is a solution to it. 10 years on, we're still in the same position. So this all comes about, so because of how tax codes are applied to pension income payments. So the rules from HMRC, first of all, we have to look at the current year. We have to look at the tax code that's been provided to us to apply under PAYE. So if somebody's got a current year tax code, fine, yes, we apply that tax code to their payments. Now, the problem is the first time people take an income payment from their pension, they're not very likely to have their current year tax code. Normally what happens is you take your first income payment, and then your tax code gets updated, and HMRC will issue it. And so you can apply the current year tax code to your second, well, I would say to subsequent payments in the tax year. And normally it does. If you're starting regular payment, it will put it right over the course of the year. And we did have some good news on this in the January pension schemes newsletter. HMRC have confirmed, like from April 25, they have sped up the process with this. So as soon as we make the first payment under PAYE, we don't have to separately report that to HMRC in order for them to update the tax code. It will happen automatically. So we should see people get current year tax codes through quicker, and we should be able to get them in the right position quicker than previously. However, it doesn't change the situation for the first payment that they take in the tax year. So if you don't have a current tax year code, then the next question we ask is if you've got a current year P45. If they have, then yes, we can use the code off that, but we still have to apply it on a month-one basis, which is very important. And if they don't, which is probably most people, then we have to use an emergency tax code on a month-one basis. And the issue really is this month-one basis more so than what their tax code actually is that creates the problem. So month-one tax codes, then, it means that the tax you pay is based on that pay period only. So you get 1/12 for the personal allowance, so £1,048, a 12 for the basic rate band, 12 for the higher rate band, additional tax thereafter. Obviously the bands are different. If you're up in Scotland, the theory is the same, the bands are different. Obviously have more rates, gets a little bit more complicated north of the border. Month 12 payments, you can have the tax is based on the full year. So you get your full annual allowance, full personal allowance, full basic rate band, high rate band, additional rate tax thereafter that. So even if a client tells us this is the only payment they're taking in the year, we still have to apply it on a month-one basis, even if we know there aren't going to be any other payments. Even if somebody takes a payment on, let's say, the 5th of April, if we were able to make a payment on the 5th of April, the last possible day in the tax year, they've not taken any other payments in the year, there's no way they could have another payment. We still have to do it on a month-one basis. It makes no difference whether you take it in, May, December, February, whenever in the year, we have to apply it to the first payment on that month-one basis, which means, particularly people taking large payments, they're going to be overtaxed because they're going to be taxed as if they were taking that same payment every single month of the year, not just the one payment that they're taking. And this can have a big impact. So, if you've got a client who needs a set amount of money, a one-off payment they need for a certain purpose, one amount of money, how much money they need to take out of their pension, because they need to account for the tax. So, for example, if you've got a client who needs £40,000 to hit their bank account, the question is how much do they need to withdraw in order to achieve that? And it's quite a scary big difference from what you would think, because of this overtaxation issue. So the answer is £70,000 to get £40,000 out. So up here on the month one basis, you take £70,000 out, you have a 12 for the personal allowance, you have an amount chargeable at basic rate tax, you have your amount at higher rate tax, and the vast majority of that payment falls into the additional rate tax band, so you're paying 45% tax on it. Total tax bill there is £29,931 to give you a net payment just over that 40,000, which is your target sum. Whereas if we were allowed to apply it on a month 12 basis, then you'd only need to take out £46,860, because the only tax you're going to pay is going to be at basic rate, which is how it should be if you're only taking £40,000 in the year, and that gives you £40,002. Now, I'll talk about in a moment, you know, there are ways obviously you can claim that back. It is only temporary, but of course you claim the tax back, you get the money back personally. It's not in your pension. You've had to crystallise, sorry, this is talking about income payments. You've had to take a larger sum out of your pension than you would want if you don't need to have this extra money. You know, you'd get the £23,000 tax back, but actually, did you want that, or did you want it to be in your pension? So you know, you can't be put back in the same position, because, you know, you've got to, because yeah, you get the tax back personally, but you've had to take more out of your pension and take more out of the tax wrapper on that. We would love to be able to apply a month 12 circumstance, month 12 code, you know, when we know the client's only going to take one payment in the year, but, you know, rules are, HMRC rules are, we're not allowed to do that. The way round it really is, if at all possible, which obviously depending on how urgently you need the money, would be to take a small payment first to trigger getting the correct tax code. If you get a cumulative tax code, you know, take, you know, take £10 out as a one-off payment just to trigger getting the tax code, and then once the tax code has come through, we can then apply it to the larger payment that comes second. So you're not going to be able to do that in all circumstances if it's urgent, but if you can, then that is probably the best solution that we've come up with, you know, under the current rules at the moment. So in terms of getting your money back then, there's a few different forms which will depend on your circumstances. So if you have extinguished, if that lump sum payment takes everything out of the pension, then we have a form P50Z if they don't have other pension income, or 53Z if they do. These are all available and can be completed online at HMRC. But if it's not been emptied and there aren't any further withdrawals to be made, then it is the P45 form that you would need. I say you can wait to the end of the tax year, and you know, it will all come out in the wash, but you know, depending on when the tax year is, and you may not want to do that. And they do, I think they do turn, to be fair to HMRC, I think they do turn around the claims pretty quickly. I think you normally get it back within 30 days once the form has been submitted, but obviously we'd much rather that you didn't have to overpay it in the first place. Okay, that's nearly all from me. So just to summarise then, obviously we've got the normal minimum pension age 55 going up to 57, but there are certain circumstances where pensions can be accessed earlier if they have protected pension age, or in the ill health condition has met. So that's the one about stopping work and being unable to work. All lump sums are tested against the lump sum allowance, lump sum death benefit allowance under the new regime. We have no limits on taxable income, so any income payments and income options, there's no tests on those. Fund splits does depend on the provider, whether they are ring fenced or notional. So I think it's slightly more common to have notional, which is what we do at AJBL. Statutory override can be useful if you have people, particularly, you know, if they've got protected tax-free cash, but they're in a scheme that only says you can buy an annuity and they don't want to buy an annuity. It's just one to be aware of. And to say overtaxation is unfortunately still an issue for ad hoc payments in pensions, people taking their first payment. So just one to be aware of. I say take that small payment before if you can, if that's an option. Or, you know, if it's not and they need it, just, you know, obviously make sure the client is aware of how it's going to be taxed, because otherwise they'll have a bit of a nasty shock when they see how much has come out against it. So it's better to be prepared in those circumstances. Okay, that is all from me for today. I do hope that has been useful, and thank you for your time.